Welcome back to session 3. My name is Brandon Gipper. In this session, Professor Amanda Beck of Georgia State University will present strategic reporting by nonprofit hospitals, examination of bad debt and charity care. She'll present for 15 minutes, and then Professor Ranjani Krishnan of Michigan State University will discuss for 15. And then, like other sessions, we'll have 15 minutes of Q&A. For this, I'm assisted by Stanford PhD student Sean Shi. Like prior sessions, I'll remind at 3 minutes when time is up. So with that, let's go ahead and begin. Amanda, I hand it over to you.
All right, thank you. You guys can see my slides, is that right? All right, well, I appreciate that. I'm really excited and honored to be part of this year's conference. The format's a little different thanks to the pandemic. But the good news is I get to talk about an industry that everyone has certainly thought about this year, but hopefully not had to visit, and that is nonprofit hospitals. So this is co-authored work with Colin Gilstrap, Jordan Rippey, and Brian Van Sant, and we each bring a unique perspective to the paper. We're really excited about the possibility of getting these ideas and our findings out into the world. So I'm going to kick off by just sharing what those findings are and how our research contributes. So in addition to documenting that in general, bond issuance can motivate strategic reporting by nonprofits, our most important contribution is being the first to document cost shifting by nonprofit hospitals from bad debt to charity care. So there's a good chance that most of you aren't familiar with charity care or why these two accounts are distinct, but I'm hoping that by the end of this presentation, you'll see why we thought it was an important thing to study this strategy and why this shifting can be really problematic. First of all, an important feature of reported charity care is that it's used to justify nonprofit hospitals' tax exemptions. So our findings also contribute to the broader stream of research, much of which is represented at this conference, by examining how entities might strategically respond to economic policies like tax incentives, which are meant to encourage charitable activities or socially responsible behavior. So after a year like 2020, I don't really have to defend the importance of the healthcare sector in general, but you may not know that most nonprofit hospitals in the US are tax-exempt nonprofit hospitals. So hospitals also make up a large part of the nonprofit industry. Only 2% of nonprofits are actually hospitals, but they account for the majority of total nonprofit revenues, and they issue about 40% of nonprofit bonds. And so these kind of numbers reflect how, in general, nonprofit hospitals are really known to operate much more similarly to their for-profit counterparts than other types of nonprofits do. Typically, we think of a nonprofit just like it sounds. All the revenues go towards community benefits, and so there are no profits. Governments subsidize these nonprofits in exchange for providing those community services through a variety of tax benefits and exemptions. In the case of nonprofit hospitals, these exemptions are valued at almost $25 billion, and they include the ability to issue tax-free municipal debt. So nonprofit hospitals in particular face a lot of scrutiny because often they're actually quite profitable. They might have profitable business lines like a cosmetic surgery unit, in addition to their less profitable services like behavioral health. So there's this tension between the profitable and charitable functions of the hospital. And because of the tax benefits that they receive, the tension actually contributes to quite a lot of controversy. So lots of drama does make the setting interesting, and these are just a few headlines to illustrate how much scrutiny these hospitals are under, particularly regarding the value of their tax benefits and whether they provide enough charitable services to deserve those benefits. This type of attention does create incentives for nonprofit hospitals to report higher levels of charity care in order to avoid having those tax benefits challenged, even though providing charity care is obviously not profitable. So it's really not unlike the for-profit sector where managers have to weigh shareholders' concerns about profitability with concerns regarding like social responsibilities. So in this paper, we look at whether hospitals seek to satisfy both these institutional expectations as well as their economic incentives by strategically shifting costs between two categories of what hospitals call uncompensated care. Specifically, we look at shifting from bad debt expense to the charity care account. We've seen claims in the media, and we've even had off the record conversations with people in the industry that suggest this type of shifting might occur. Both accounts are income decreasing, and they seem similar on the surface, but they represent two really different things. First off, it's important to understand that nonprofit hospitals cannot refuse patients' care. The IRS guidelines are very clear on this. They must provide care regardless of a patient's ability to pay. So when the patient walks in, the staff person follows the hospital's policy to determine whether the patient should be considered a charity case. And if so, they won't be charged for services. And so the decision is based on things like employment status, insurance coverage, that kind of thing. The hospital then reduces income by recording charity care, which is equal to the cost of services. And those costs are known at the time that they're recorded. So charity care is a fairly direct measure of the value of the social goods provided. And so these are the costs that regulators use to evaluate tax exemption eligibility. On the other hand, for regular paying patients, accounting for bad debt is just the same as usual. We recognize revenue when services are provided, and we record an estimate of the uncollectible revenues as bad debt expense. So we essentially propose that under some conditions, management might be more generous with the charity policy, particularly for patients on the margin. So let's say this guy here is on the margin, like maybe he has a decent job, but really bad credit score or that kind of thing. If we move him to charity care, the remaining pool of patients actually improves in credit quality. So charity care is legitimately higher, and without the marginal patient, bad debt expense is legitimately lower. So to regulators, community benefits look better, and then to creditors, revenue streams and collection efforts look better. So this kind of leads one to wonder why hospitals wouldn't just do this all the time. So importantly, hospitals are not allowed to pursue collection from charity patients. So there are potentially real costs associated with this strategy because some of those marginal patients may have actually paid. So for management to use this strategy, there would need to be clear benefits to justify those costs. For example, bond insurance. In this case, hospitals or issuance, not insurance. Hospitals are facing extra scrutiny from regulators because they're taking advantage of their tax benefits, and there's scrutiny from investors because investors are evaluating default risk. So we basically argue the following. Investors are relatively more focused on bad debt expense than on charity care because first, bad debt expense is an estimate. It speaks to the certainty of future cash flows and whether management is any good at making estimates and collecting revenues. All these metrics are relevant for assessing default risk, but the link between charity care and those types of metrics just isn't as clear. Plus, investors should expect nonprofit hospitals to incur charity care costs. Otherwise, they can't even issue tax-exempt debt. Now, regulators care relatively less about bad debt because it's really not an authentic measure of charitable activity. And so the hospital is trying very hard to recover revenues from the non-charity patients. So this is a setting where the benefits of appearing more creditworthy and more charitable might offset the cost of the strategy. Potentially, the strategy allows managers to kill two birds with one stone, like this. So to summarize our main findings, first, previous nonprofit research hadn't examined strategic reporting around bond issuance. So we start by testing whether average bad debt expense tends to be abnormally low before bond issuance. All the financials in our data set are audited, and these hospitals are closely monitored by regulators and investors. So there's plenty of reasons to believe that managers would not bother with these types of manipulations. However, we do find initial support for a lower discretionary bad debt prior to issuance. Next, we look at the association between discretion in the two accounts. Note that typically we would expect bad debt expense and charity care to move in tandem. So like if there's a downturn in the local economy, that would be likely to increase both the need for charity care and AR delinquencies. But if there's a shifting between the two accounts, then we would expect an inverse relationship. And that is what we find prior to issuance. So to perform our tests, we utilize a data set of California nonprofit hospital financials over an 11-year sample period. And we follow prior research to model bad debt expense and discretionary charity care. So based on Leon and Van Horn 2005, we model bad debt expense as a function of changes to revenue in total, and then streams from Medicare and Medicaid. And then based on Brian's 2016 paper, expected levels of charity care are modeled as a function of attributes that relate to the community's expectations about charity care provision and the amount of tax exemptions it receives. So we have variables like size and uninsured patients and whether it has a trauma facility, that sort of thing. And so the residuals from these models are measures of discretionary bad debt expense, DBDE, and then discretionary charity care, DCC. So I'm going to show you some figures to visually illustrate what we believe is happening with this shifting. Our first hypothesis predicts a decrease in discretionary bad debt in year T, so that's the year prior to issuance. And that's what we see here for issuers relative to non-issuers. And by the way, we do also use a regression and find statistical support for our hypothesis in the paper. So if the drop in discretionary bad debt were solely the result of accrual manipulation alone and no shifting, we would expect a couple of things. First of all, receivables turnover would decline because net receivables would be overstated. Second of all, there would be no change to write-offs because accounting estimates don't actually influence collectability. However, what we see visually is that the lower bad debt expense is accompanied by a higher receivables turnover and lower write-offs. So both of these are more consistent with the recategorizing of marginal patients as charity, making the non-charity patient pool more creditworthy. Moving into our statistical analyses, our main hypothesis is that we expect a negative association between discretionary charity care, which is our dependent variable here, and discretionary bad debt expense prior to issuance. Our main result is consistent with these hypotheses. This hypothesis, we find a significant negative association on the interaction here of discretionary bad debt during the year preceding issuance in both tables 3 and 4. In table 4, we do a 3-year run-up to the bond issuance. And then just to confirm, the sum of the interaction and the main effect are also significantly negative. We also look at debt costs, since presumably that's what drives managers to shift prior to issuance. And so what this table basically tells us is that hospitals in the lowest third of discretionary bad debt expense do have lower debt cost. And then skipping over to column 6, which we can thank one of our reviewers for suggesting, the result does appear driven by those hospitals that we identify as likely shifters. So that's the hospitals that have both lower than expected bad debt expense and higher than expected charity care. And so the strategy does appear to be primarily motivated by bad debt, because we also don't find a direct association between discretionary charity care with interest costs. And that's consistent with our logic that bad debt is a higher order concern prior to issuance. And it's also consistent with an untabulated analysis that we do where we don't find a direct association between discretionary charity care and issuance. So unlike the plot I showed earlier where we saw a drop in discretionary bad debt, we don't see the same for discretionary charity care when we look at it alone. So we dig a little deeper with some additional analyses. First, Krishnan and Yetman 2011 find that hospitals that face greater institutional pressures, like church hospitals or hospitals with higher levels of donations, shift costs between categories of IRS 990 expense items to appear more charitable. And so our findings are consistent with that. We find our results are stronger for those types of hospitals. And then finally, there's a commonly referenced rule of thumb that says that nonprofit hospitals should provide charity care of at least 5% of revenues. And the rule is not a legal policy, at least not yet. I mean, I think it is in Texas, but other than that, it's just been proposed a lot of places, including California. And we see it referenced a lot by the media and lawmakers in various places. So our expectation is that if regulatory scrutiny increases when hospitals issue tax-free municipal debt, that hospitals farther from the 5% threshold would want to increase discretionary charity care to meet that rule of thumb. And so we find results consistent with that expectation.
Man, about 2 minutes left.
Okay, well, this is my last slide, so that's great. And so I'm concluding now that there are basically important distinctions between bad debt and charity care accounts. So to the extent that strategic cost shifting could inappropriately influence decisions by investors and by other stakeholders. This type of shifting is problematic. Transparency in reporting uncompensated care accounts is tremendously important to this industry because of those 25 billion in tax exemptions that give nonprofits a significant competitive advantage over for-profit hospitals. And that reduces the competition for quality healthcare. So in summary, by documenting this behavior, we contribute to the discussion by showing one potential consequence of using tax benefits to encourage entities that are otherwise profit focused to provide social goods. So thank you so much. I look forward to your feedback and to Ranjani's discussion.
Thank you so much. I'd like to begin by thanking the organizers for inviting me to discuss this paper. I thought Andrea did a fantastic job presenting, and I'm excited to discuss the paper. So let me get right down to the merits. I think this paper looks at several really important issues. First of all, it's an important policy question. When I started working in healthcare 28 years ago, maybe, it was an important topic, and I cannot think of it being any less important today, only more important. The potential contribution to accounting is certainly salient to me. And I thought the paper was really well written, for which I'd like to thank the authors, because it really made reading pretty straightforward. I'm just going to talk, let me say, my suggestions are more like friendly amendments rather than anything else. So I hope they're taken in that spirit. These issues that I'm going to raise deal with the following topics. First of all, the whole role of institutional theory in this paper. The second is I was just questioning the premise, and maybe if that could be clarified about what do bondholders really want. And in terms of classification, a bit of a struggle I had about cost shifting versus operational improvements, some small issues related to time period, and a few issues related to the residual model and the changes variables. First, in terms of the theoretical framework, I like to draw a predictive validity framework. And so at the conceptual level, I think what the authors are looking at is the association between institutional pressures and what we can loosely call measure management. At least this is how I read the paper and the hypothesis. And this is operationalized as type of nonprofit for the institutional pressure and cost shifting for measure management, with a few controls thrown into in the equation. So let's take the first link, institutional pressure and measure management. I was actually quite, let's just say, not sure, but what is an institution in this particular setting? And here, I would kind of suggest that the authors look at the institutional theory, which is, I'm sure, as you know, a really rich area of literature in sociology, management, and some other areas. And the essence of institutional theory is the following, that in addition to material resources, organizations also require legitimacy, credibility, and social acceptability to survive and thrive in the institutional environment. And so contrary to, I would say, a conventional economic view of the firm, where organizations are rewarded for effective and efficient control of their production system, institutional theory says that organizations also require social acceptability, credibility, and legitimacy to survive their environment. And so I'm just showing literally a sliver of institutional theory. This is a very robust body of literature in sociology and management. Essentially, I did want to point out that several institutionalists came from Stanford. John Mayer, for example, one of the early institutionalists, said that there's a conflict between institutional and technical pressures. And later institutionalists like Richard Scott, also from Stanford, posited that all organizations operate in both technical and institutional environments, but the extent of pressure varies. I do want to pause here and point out that one of the ways to deal with institutional pressures is regulatory capture. So that is also could be actually put under this umbrella, something that we accountants like a lot. But essentially, most of the organizations that we are interested in fall under this highlighted 2 by 2 of high technical pressures and high institutional pressures. And again, I just want to show a sliver of the literature, as I said, that when you think of institutional theory, there are these basic pillars, what they call the regulatory pillar, the normative pillar, and the cultural cognitive pillar. The regulative pillar is very much like conventional economic theory, where expedience, regulative rules, coercive mechanisms, and instrumental logic, rules and laws, and fear or guilt, and it's legally sanctioned. The normative and the cultural cognitive are, for lack of a better word, more qualitative. So these are things like normative expectations. Accounting is a very normative field, which is why we need CPAs and we need 150 hours and so on and so forth. And there is a moral element to this and an honor element to this. The cultural cognitive is mostly what we call mimetic, and there is an orthodoxy to how firms do things, and this is culturally supported. So the point here is that there is either stay with institutional theory and dig way deeper, or perhaps just drop this theory, which might actually be the easier thing to do, but I leave it to the authors to decide what to do. The next question I was wondering about was, what do bondholders really care about? Are bondholders institutions? And in this regard, I started wondering who buys hospital bonds. So it turns out in California, there are two types of bonds: revenue bonds, which are backed by a pledge on the beneficiary enterprise's revenue, and general obligation bonds, which are backed by the general revenue of the issuing municipality. So GO bonds are almost always voted in general elections, and they're almost always voted along partisan lines. You had one big one in California in 2020, by the way, a hospital bond issue. So unsurprisingly, Republicans vote against bond issuance and Democrats vote for bond issuance. So the people who vote for these bonds, are they the institutions, or are people who buy these bonds institutions? And that was not clear to me when I was reading the paper. So the other thing that I started thinking about institutions is, do these institutions really care about the difference between bad debts or charity care? My sense is they actually care a lot about community benefits, which includes both charity care and bad debts. In the IRS 990, 8 categories of community benefit activities are allowed, of which only 1 is charity care. Well, bondholders could also care about risk. And if they do care about risk, then well, both charity care and bad debts impose similar types of business risks. Finally, something that was kind of hinted at in the paper is that perhaps they care about controllability, which is that bad debts are less controllable and charity care is more controllable. But if that's the case, why should I care about controllability just the year before the bond issue? Wouldn't I care for several years before the bond issue? Also, wouldn't I worry about manipulability of a measure in addition to controllability? So that was something that wasn't very clear to me. The next arrow that I would like to look at is the conceptual versus the operational link. I wasn't sure here how well this was developed in the paper about whether nonprofit type is really a good proxy for institutional pressure, and if so, what type of institutional pressure? So this, if they could just develop this little better. Now I come to the cost shifting. This was where I had, to tell you the truth, maximum trouble. I wasn't sure if the dependent variable is really picking up cost shifting or genuine operational improvements. You mentioned presumptive eligibility, and there's plenty of literature that I'm sure the authors are familiar with, but let me just show you this diagram. Just look at these two graphs. UPMC Mercy introduced an information technology system whereby they could do a better job identifying charity care patients. And in 7 years, their bad debts as a proportion of total bad debts and charity care went down from 75% to 17%, with a corresponding increase in charity care. And this was basically due to investments in information technology. And there are a few information technology professors in Carnegie Mellon, by the way, who have studied this and published this. So what is this role of presumptive ability? So as Andrea mentioned, charity care is determined at admission, whereas bad debts are determined if there's a failure of collection efforts. The problem is most patients eligible for charity care do not fill out these forms at admission. Why is that the case? Turns out the biggest reason is fear. fear of losing some other public benefit, fear of job-related repercussions. There's other barriers, language barrier, memory loss or cognitive limitations are a big deal. Lack of ID is a big deal. So the point here is hospitals invest in IT so that they could improve this presumptive eligibility assessment. The problem is this will appear as cost shifting in the analysis. And so this is something that I think if the authors could do, just address this a little bit more detailed manner. Small issues, data are available from 1979. I'm not sure why you had a shorter sample. I was not sure how you calculated aggregates. But I do have a couple issues about the models that I wanted to mention. So model 1 regresses this change in bad debt expense on change in various revenues, and it uses the residual to estimate abnormal bad debt. I found the model to be underspecified. There's lots of other factors that can affect bad debt expense, and these are actually in your second model, but they should be in the first model. But note that the residual in this model provides the abnormal rate of change. Now, model 2 regresses charity care on many variables and uses the residuals again, but it is a charity care level. I wasn't sure why model 1 was a change on change model and model 2 was a levels model. The authors have certain assumptions about how they explain how they think bad debt expense remains a constant proportion of revenue stream, but charity care is based on normative expectations. The problem in this is that this is contradictory to H1, where it says that managers can reduce bad debts. Well, then either it's mechanical or it's not. It can't be both. So if only they could just specify this better, I think it would really improve the paper. There are a few other controls, market share, per capita income. I'll pass these along to you. You can easily control for these. You have the data. The other thing about the model I want to mention here, and this is just towards the end of my presentation. So model 3 regresses discretionary bad debt expense in time t. It tests the relationship between abnormal bad debt expense and future bond issuance. Control for system here is important. Hospital systems have oversight over bad debt expense. I think you should control it in the first step. Now, model 4 regresses abnormal charity care in time t. Model 3 controls for the lagged dependent variable, but model 4 controls for the level of charity care. And I think the lagged discretionary charity care is an important explanatory variable for discretionary charity care, and it needs to be included in the model. Overall, I found a lot of inconsistencies between how bad debts were modeled versus charity care was modeled, and I would really appreciate some consistency in this. I think that would really help the reader a lot. Finally, I wasn't sure why you used a two-step model and whether you had considered something else like a simultaneous equations model or a PSM model, for example. And one last minor suggestion, can you use an acronym other than BDE? Because it means quite something different in the Urban Dictionary, as you know. Anyway, I wish the authors good luck, and thank you very much.
Great, thank you so much. Amanda, would you like to take a minute or two to respond to the discussion?
Yeah, sure. And I want to thank Ranjani so much for giving it such a good read and for all that constructive feedback. Some of it I will have to marinate on with my co-authors for a little bit longer, but I do have a few things that I jotted down that I could maybe just clarify right now. So kind of just working backwards. Some of the things you mentioned were actually things that the reviewers also brought up and that we had are working on incorporating to the review report, but maybe they actually belong in the paper itself. So one of those things was including all of those Model 2 discretionary charity care controls in the bad debt model as well. And we did run that robustness check and find everything was consistent, but it'd probably be worth thinking about whether that is just how it ought to be. We did want to follow research. The Leon and Van Horn and Vanciant already published models, and that sort of related to our choice for using levels versus changes as a dependent variable. Both of those residuals are an amount, a dollar for dollar amount of unexpected charity care and bad debt. So they are comparable in that sense, but it's something we kind of struggled over, whether we wanted to depart from what had been done just for the visual of seeing. To us, it felt a little bit like the visual of seeing two models that clearly had comparable residuals versus the ones that you have to kind of think about whether or not that is truly comparable. So again, worthwhile to think about whether we made the right choice there. And so one thing I wanted to mention too is the institutional theory. It sounded like you didn't really think we needed it. And it's not been easy for us to write. I mean, we wanted to write that in. That's kind of where we came up with the idea, where it originated. But over time, it seems that the struggle may not be worth it and that we may not be successful. So that's something that we can look at as well. And then finally, just to clarify, these are revenue bonds, so they're not obligated. They wouldn't have gone for a vote because they are obligated by the hospital. So hopefully we don't have any issues there, but need to clarify it in the paper because we did not. And then I think the last thing that I had jotted down was just the controllability of charity care versus the risk of bad debt expense, or like really what was it that bondholders cared about, I think is the way you phrased it. And it's really funny because we had gone down a route for a long time of the controllability explanation. And there's tension with all those explanations, as you mentioned. You could say that bondholders care about the controllability of charity care versus the lack of controllability about bad debt. But then, as you mentioned, do they not care about it 5 years beforehand? And so you kind of brought up the tension with all of those. And I think maybe in the end, what we should do is focus more on trying to clarify exactly which of those explanations we are going to use, but then also note that there's tension in that explanation, whatever it is, because there will be tension regardless of which explanation best fits what we find. So anyways, there's some other things that we can talk about, I guess, offline, but I really appreciated the detail of that discussion, and thank you very much for your feedback.
Great. So I think maybe I'll follow up on some questions that are related to the incentives of bondholders. We did get a number of questions about that. So maybe one of them from T's at University of Washington is asking, is it plausible that creditors have CSR motives and prefer to lend money to hospitals that do charity care, and so they prefer to see more charity care rather than it being a bad debt expense related concern that they have?
We thought about that before, and that's why we actually, in that, it's probably too fast on the slide to really absorb, but we have both a high discretionary charity care and a low discretionary charity care variable that we test for that cost of debt model. And we're never able to find a direct association between charity care and issuance or cost of debt. And so we don't find evidence to support that, which doesn't necessarily mean that it's not possible that it's true. But we only find it when we look at the association, the inverse association between bad debt and charity care. But it did occur to me that part of the cost of debt reduction that you see, if bondholders do value charity care, then, or perhaps they just value the hospital having the acumen to do this shifting to avoid losing their tax exemptions. But it's definitely possible that the bondholders do value that, although we don't really find direct support for that.
Okay, yeah, so another question related to bondholders is Shua from Duke asks, are investors always fooled by accounting tricks? So it seems as though if this bad debt expense being shifted into charity care is something that's transparent to us as empiricists, then it would probably be observable to the investor in the bonds. And so they would potentially not be fooled by that sort of shifting. So how do you think about that?
Well, I don't personally have an objection to the idea that investors could be fooled by things because I think that we see that in not just in this setting, but really in many settings that examine earnings management. But I think it's also a question in our case of whether fooling is really the right word here, because our theory is that this may not really be, this is not purely an accounting manipulation. Prior research has already shown that nonprofit hospitals manipulate accruals in the bad debt account, but we aren't really looking at accrual manipulation necessarily. If, as I mentioned, if there is an increase in charity care, it could be, it could be legitimate that there would be a decrease in bad debt because you're moving the marginal patients. Now, there's also the question of whether or not bondholders are being fooled because they are taking something to be persistent that really is just happening on a one-off year for a couple of years off. And so again, I don't really take an issue with the idea that investors might be fooled by that, because we've seen in the corporate side that bond investors can be fooled by earnings management. And in the nonprofit setting, we see that donors can be fooled by poor quality program ratios. So, I think that's basically kind of my twofold response, is that I think it's conceivable that they could be fooled, but I also don't necessarily think that this is the hospitals pulling one over on them, because it's not really purely an accounting manipulation.
Yeah, I think there's a number of questions related to what are managers doing exactly? Like, are they doing manipulations, or are they doing something that's more like a real adjustment to how they allocate patients? So for example, Sora from SMU asked, is it possible that the hospitals are just making these real adjustments to their collections behavior or their screening of patients around the time of when they issue bonds, because they want to signal something to the bond market about their quality or something of that nature?
Yeah, so it would be probably difficult or maybe even impossible or we have not at least determined how we would parse out between the timing of this adjustment. So whether that is ex ante, an actual adjustment to the policy, or communicating somehow to your staff that we're going to be a little bit more lenient, or if it's something more like you get to the end of the year, you're about to issue a bond and you see that there are clear uncollectible accounts that beforehand you expected to pay, and now you're going to just simply recategorize them, which is a little bit more coming on the gray area of whether or not that's actually appropriate under the accounting standard. And so, I mean, we don't really, we've done some things in the background to try to parse that out. Like, for example, at one time we looked at the actual number of patients in charity care. We had an analysis at one point where we found that the cost per charity patient was also increasing. So that kind of suggests a reallocation if you believe, and we're too timid to suggest this, but some might think that hospitals would be willing to do more expensive treatments if they expect it to be repaid initially. So finding that the cost per charity patient goes up could be consistent with actually recategorizing, after the services are provided. But either one of those things could be a possibility.
Yeah, related to recategorization, Yang from Shanghai University of Finance asks, what would be consequences if regulators caught these, if they are manipulations? And I don't know, maybe you can define, is it a manipulation or not? Have you seen any examples of what the consequences are for these sorts of recategorizations if regulators frown upon them? Yeah,
well, so directly shifting around bond issuance, no, because we're the first ones that we know of who've looked at that. But there are some cases. I was reading in a law journal that covered this topic. It was, I don't know, we'll say 10 years ago, that there was a case, which I can remember all the details, but the highlights were that the court basically ruled against this hospital's tax exemptions because the hospital was trying to pass bad debt off as charity care and wasn't providing enough of what they viewed as legitimate charity care, which means when the patient comes in, we perform services without any expectation of being paid, not we chase you down for payments, and then when you don't pay, we say that it's charity care, or we're still trying to pursue payment. So that hospital did lose its tax exemptions, and I think although I can't speak to exactly what would happen to the hospitals that we categorize as shifting, I think that if there were evidence that a hospital were only meeting this normative requirement or policy requirement of 5% because it was by and large reclassifying bad debt as charity care, then I would absolutely expect that to be threaten the tax exemptions of the hospital based on what we've seen.
Okay. Yeah, there was a question about were there any examples of hospitals getting stripped of their tax exempt status, so this is interesting. Let's see, maybe another question related to some institutional details is from Lynn at University of Arizona. So what are the roles of credit rating agencies in these bonds? I don't know if they receive credit ratings or not. And if so, are the rating agencies looking at these types of turnover ratios of receivables or charity care being performed, et cetera?
Yeah, so all of these bonds are rated in our sample by one of the major rating agencies. And we went to the rating methodologies to get some background knowledge of whether or not bondholders were focused as a first order concern on charity care, because there are legitimate reasons to think that an investor or a rating agency might see high levels of charity care and think, oh, well, they're serving a really like poor patient pool or that sort of thing. And so we did go there, and what we found was no real direct reference to charity care as a metric for determining the rating, but we did find references to receivables turnover. Bad debt expense for these hospitals is very large. It's so much larger than what you'd ever see for a corporation. I don't remember the exact amount, but it's in our descriptive statistics, but it's just much larger. It's not what we see in the regular setting. So it is a focus, particularly here, what the receivables turnover and what the collectability of the revenues is.
So maybe a couple more questions about the timing of when managers decide to issue bonds or when hospitals are in need of new capital. So John from WashU asks, given that these nonprofit hospitals are nonprofit hospitals, could a potential story be that they issue bonds when they need funding and thus there are more non-discretionary bad debts happening rather than discretionary bad debts? And so some of this might get picked up in the non-discretionary component rather than the discretionary component.
Yeah, so we have had that question before. And so we had done a few tests to look at whether or not these hospitals differ materially before versus, or particularly if the issuers differ materially from the non-issuers. And we don't find much evidence to suggest that they do. And it seems, just based on some of the other research that's been done, I think from the finance area, that there are really incentives for these hospitals to issue tax-exempt debt regardless of what. It's useful to look for reasons or ways to use the funding because they can use it for any project that provides community benefit. So if I have cash on hand and I would really have two projects in mind, one is for a really profitable non-community benefit type service, and the other is for something really almost anything else, you know, an emergency room, whatever, that is going to have community benefit, then there are advantages to issuing debt just to pay for whatever it is that I have coming up that I can issue tax-free debt for, because it's a very low cost of capital as opposed to using what I have on hand. So I think that that's why a lot of hospitals take advantage of this, is because they have these nonprofit parts of business, but they also have very profitable parts of business. They have access to a tax-free market, so it makes sense to sort of move their funding around in order to issue debt for such a cheap rate, basically.
I think we have time for maybe one more question. So this is also an institutional question. Nikki from University of Georgia is asking, language around nonprofit charity care policy might imply that they have some bright lines that they try and stick to. Would you expect the hospitals that are potentially coming into a bond issuance to try and adjust their policies or how they have structured their decisions to make these sorts of allocations to charity care versus not, to change coming into it? And can you potentially provide evidence of that?
So I think I need a little bit more clarification on the bright line thing. Is that referring to the 5% threshold that I mentioned? If it is, I know we don't really have the back and forth ability, but we do find the evidence of trying to meet that threshold prior to issuance. So even though, just a simple association between discretionary charity care and bond issuance isn't really, it's not statistically significant, but if we interact that with the distance that hospital is from meeting this rule of thumb, 5%, we do find that there is an increase in discretionary charity care, which I think suggests that prior to bond issuance, that there would be an incentive if you're under that threshold, that you would increase it either to meet the regulators' expectations so they don't challenge the exemptions, and or to please bond investors, because certainly bond investors are not going to want the tax exemptions to be in jeopardy. So I think it can be both.
Great. So thanks, Amanda, so much for presenting your paper. And Ranjani, thanks so much for the great discussion. So that's the end of session 3. I look forward to seeing everybody in 10 minutes at 4:55, back for session 4. Thank you.